El Salvador has announced plans to repurchase some of its dollar-denominated bonds amid a decline in risk premiums. The nation aims to buy back bonds due in 2025, 2027, and 2029. This move follows previous buybacks as part of President Nayib Bukele's efforts to restore investor confidence. Despite cautiousness from fund managers due to fiscal concerns and delays in securing IMF loans, the bonds have appreciated amid a broader emerging market debt rally. The buyback offer expires on April 15th, managed by BUFA Securities, Inc. Dollar-denominated bonds, also known as sovereign bonds or government bonds, are debt securities issued by a national government in a foreign currency, typically the US dollar. These bonds are a way for governments to raise funds from investors to finance various projects such as infrastructure development, social programs, or debt refinancing. When a government issues bonds, it essentially borrows money from investors who purchase the bonds. In return, the government promises to pay back the principal amount, the initial investment, at a future date known as the maturity date, along with periodic interest payments. For investors, buying government bonds can offer a relatively safe investment opportunity, as they are typically considered low risk due to the backing of the issuing government. However, the return on investment, or yield, may vary depending on factors such as the creditworthiness of the government issuing the bonds, prevailing interest rates, and overall market conditions. In the case of El Salvador's bonds, the government is offering to repurchase some of these bonds from investors. This could be motivated by various reasons, such as managing debt obligations, reducing interest expenses, or signaling confidence in the country's financial stability. El Salvador, the pioneering nation that embraced Bitcoin as an official medium of exchange, is embarking on a strategic initiative to tackle its national debt. In a bid to ease financial obligations, the Central American country has unveiled plans to repurchase government bonds nearing maturity as outlined in a recent press release. This marks a significant move as El Salvador seeks to bolster its economic resilience amidst evolving global financial landscapes. The targeted bonds, set to mature in the years 2025, 2027, and 2029, represent a combined outstanding amount of close to $175 billion USD. Bondholders are granted until April 15th to avail themselves of the buyback offer, with specific terms and conditions slated for imminent disclosure. The announcement has already catalyzed a surge in the prices of these fixed-income securities, indicating a favorable market reception. President Bukele, a prominent advocate for Bitcoin adoption, underscored the government's commitment to fiscal prudence by sharing the price chart of the affected bonds on social media platform X, formerly Twitter, drawing attention to the proactive debt management strategy. El Salvador's strengthening financial position with its initiative, which comes against the backdrop of El Salvador's improving creditworthiness on the global stage. Since the onset of the year, the interest rate differential between US and Salvadoran government bonds has narrowed by 57 basis points, settling at 6.2%. This trend reflects growing investor confidence and a diminishing perception of credit risk associated with El Salvador's sovereign debt. Notably, rating agencies, including S&P Global Ratings, have revised El Salvador's credit rating upwards, albeit from a relatively modest starting point. El Salvador's building on past successes is a proactive approach to debt management, and it is not unprecedented. In previous years, the country has successfully executed bond buyback programs, thereby regaining trust and credibility among international creditors. In 2023, Salvadoran bonds outperformed expectations, yielding a remarkable 70% increase in value, positioning them as some of the most lucrative emerging market securities. Challenges and opportunities lie ahead, however. Despite these strides, El Salvador grapples with a national debt exceeding $20 billion to USD. While this figure places El Salvador's debt-to-GDP ratio on par with that of Germany, it remains significantly lower than that of economic powerhouses like the United States and Japan. Addressing socioeconomic disparities remains a pressing concern, with nearly one-third of Salvadorans living below the poverty line and lingering challenges in job creation and economic empowerment. President Bukele, buoyed by his administration's success in curbing gang-related crime, faces mounting expectations to stimulate economic growth and improve living standards. Recognizing the need for skilled labor to propel the nation forward, Bukele announced plans to distribute 5,000 free visas to qualified professionals from abroad, aiming to enrich the country's talent pool and secure its future prosperity. Amidst these developments, El Salvador's economy shows promising signs of vitality with economic momentum and global implications. With a growth rate of 4 or 5%, surpassing that of the United States and the stagnant Eurozone, El Salvador demonstrates resilience and potential for further expansion. Additionally, the nation's inflation rate, standing at approximately 0.8%, remains significantly lower than that of major economies like the United States and the Eurozone, contributing to its economic stability. El Salvador's bold experimentation with Bitcoin as legal tender and proactive debt management strategies positions it as a trailblazer among emerging economies. The nation's burgeoning tourism industry, fueled by Bitcoin adoption and declining crime rates, coupled with its market-driven economic policies, sets a precedent for sustainable growth without over-reliance on external assistance. While the impact of El Salvador's Bitcoin holdings, currently valued at around $400 million USD on its fiscal health, remains uncertain, the country's trajectory underscores its potential to chart a course for other developing nations seeking to navigate financial challenges and foster economic prosperity.